Good day. Today I want us to focus on the general ledger accounts. But let's read. KwaZulu-Natal Ltd is a public company with the authorized share capital of 1,500,000 shares. The financial year ends on 31 December each year. Required: prepare the following accounts in the general ledger on 31 December 2020. Right? So the year ends on 31 December 2020. So meaning that the year starts on 1 March 2019 and then it ends on 31 December. Sorry, I'm making a mistake. So because they are saying the year ends on 31 December 2020, it means this year starts on 1 January 2020 and then it ends on 31 December 2020. So today we're just going to focus on these two: shareholders for dividend and also dividends on ordinary shares. But before we go there, the dividends on ordinary shares. So the dividends, this is the profit that it is being paid to the shareholders in a form of dividends. Okay, so that is what is a dividend. It is a profit that is being paid to the shareholder in a form of dividends. Okay, meaning that, so if we are paying this as a business, it means that this is an expense to the business. It's an expense. Alright? And then we have the shareholders for dividend. Shareholders for dividends, these are the dividends that we are owing, or these are the dividends that we still need to pay as a business. So these dividends, they are a liability because it is a dividend that you still need to pay. Okay? Now let's go and open these accounts. Let's open these two accounts. So this is the shareholders for dividends. And then we also have dividends on ordinary shares. Right? Let's do it. What are they saying about the payments of the dividends? So you can see here in day 5, they're not talking about the payments of the dividends, but in June 2020, on Terre, they said an interim dividend of 13% per share was paid to the shareholders on the register. So we made a payment, right? So if we made a payment, it means that we have paid dividends. So if we pay the dividends, it means that the expense of the dividends, they are increasing because we have paid the expense for the dividends. So because we paid it, it's going to be the CPJ. Right? So they said interim of 15% per share was paid to shareholders on the register. So how many shares that are there on the register? So first, we have the shares that are here at the beginning of the year, which are 500,000. And then we have the new shares that were issued of 400,000. So it means that now we have the total of how many shares? 900,000 shares. So it means that you're going to take this 900,000 and come and multiply it by 13%. Because remember, they said an interim dividend of 13 cents per share. So then the answer is going to be how much? 117,000. Right? Let's continue. So remember, the dividends we have the interim dividend and the final dividends. So the interim dividends, most of the time they are paid during the year, and then the final they are paid most of the time at the end of the year. But actually the dividends, actually the final dividends, they're not paid at the end of the year. They're just being declared. That actually we're supposed to pay this dividend out to the shareholders, but the business does not owe them. So in that way, the business owes the shareholders those dividends. That is why we have a shareholders for dividend account, which shows that the company is owing the shareholders, right? So what did they say? They said a final dividend of 17 cents per share was declared. Only shares on the share register qualify for the final dividends. So now, how many shares are there in the register? Because we had 900,000 shares, but then we bought back how many shares? 50,000 shares. So it means that now we have how many shares which are left? We have 850,000 shares. So it means that we are going to come in here, right? So they said in here, right? They said a final dividends of 17 cents per share was declared. Now note this. They did not say that they were paid. They said were declared. Meaning that the business realized that it needs to pay the shareholders, but they did not pay them. So it means here the business is owing the shareholders these dividends. So we are not going to write the bank here because the business did not pay. So the account that you're going to write in here, it is shareholders for dividends to show that the business is owing the shareholders. So this answer here is 144,500. It's 144,500. Right? So the journal here it is general journal. So the account that you're going to write in here, it is shareholders for dividends. This account. This one. Shareholders for dividend. This account. Which is a liability. So we know the double entry system. It is saying that if something is debited, it must also be credited somewhere else. Besides that, the shareholders for dividends, they are increasing as the people that we as a business are increasing, because now we are owing the shareholders the money for the dividends. So it is dividends on ordinary shares. So this is how we do this. Now, I want you to note this and listen carefully. At the beginning of the following year, before the business pays other dividends, the business must first pay these dividends of 144,500. Meaning that once the business has paid these dividends in the next financial year, this will be recorded here on the debit side as a bank CPJ to show that shareholders for dividends they are decreasing, to show that the liabilities they are decreasing. As we now as a business, we are now paying the people that we are owing money. I hope you can hear that clearly. So this is how we're supposed to record this.